How's it going, guys? Welcome back to mentfx. And the one thing that you're missing in your trading is the mentorship. No, not really. The one thing that you're actually most likely missing, or something you haven't given enough thought or understood properly, is the idea of direction in the market. Now, this right here is a monthly chart on the Euro-US dollar. We were doing some markups with the actual mentorship, and we were looking at some back testing all the way back here in about 2008 till about 2014, and the amount of entries that you could have at every single one of these inefficiency areas as price developed in and around these points. Now, the reason that I bring up the idea of direction for the direction and order flow specifically is because what a lot of people do is, whether they're in retail, just normal retail based trading, or even in smart money trading, is when they look at a market like so, right, and they, for instance, anticipate a specific move that might come all the way down here and then continue higher. What they're doing when they actually find their criteria for an entry, so let's assume you undergo, wow, excuse these lines, so let's just go to go to gold, because we caught something today on gold as a team. Everyone did great. But before we go into what actually occurred here, let's talk about what the actual problem is, what the underlying problem is, and what you have most likely done a lot. So whether you're a retail trader, retail based, without any smart money, or if you've been doing smart money for a while, one of the things that you expect is that when you have, for instance, an area where you're expecting orders to be mitigated, and then you're expecting price to come in, potentially undergo some sort of Wyckoff, right, and continue in a given direction, what you're actually assuming when you do this is that this move right here is going to be infinite. Without even knowing about it, without even understanding why you're doing it, you expect that this move right here is going to amass great rewards. And like any other retail or emotional trader, you expect that once you get into your personal, your perfect refined entry or whatever, that there's literally no chance that price can do something like this. Now that's a whole load of horseshit, right? Because the reality of what occurs when Wyckoff occurs, right? So let's say we have a range. Now, if Wyckoff, for instance, comes to clear out all these lows, right, and then begins to potentially undergo Wyckoff in this area and accumulates. Now, this accumulation can do a number of things. This is where Wyckoff gets very interesting. If Wyckoff, the schematic, comes down to test your final demand zone in this case, then the anticipation usually is that you're going to have infinite upside until you've cleared everything that there is to clear, you've made new highs, and you've continued on this structural journey higher that you can just mitigate perfectly, partial perfectly, manage your trades perfectly, and make 5,000 RR in one trade. Now, the real reality of a lot of Wyckoff accumulations and distributions, and even price movement in general, is that because we're using the footprints of smart money, what you don't recognize is based on how these setups play out, these accumulations could do a number of things, such as an accumulation of this sort could have formed basically to not only scare out potential buyers in this market and get rid of them, but also to allow for the composite man or institutions to amass more sells above liquidity highs, right, where people have their buy stop orders, to amass more above newly created highs, right? And this could be all part of a markup. But then it could easily, let's assume this was a trend line of some sort, right? So let's say a trend line did exist here. It could easily also, and this is where sometimes retail trading works, right? Even though it's more so after the fact, but this is where it sometimes works. And let's say you have a where is it? This is the one I want. A supply zone up here, right? Sometimes what you'll see is this markup was only made, or this accumulation had only undergone in this specific area, so it could make a markup up into an inefficiency area, which is in this case a supply zone. Now that means that back in time, whenever the supply zone was left here, and more likely than not, you had some sort of most likely inefficiency or imbalance left behind, thereby showing you that there's unmitigated orders in this specific area. What's actually happening is the order flow of this entire market has still remained bearish. So if you actually zoomed out, for instance, and looked at what's actually occurring here, the market order flow is still shifting and continuing in most likely a bearish manner. Now, as it does this, it can and it will build liquidity on both sides of the market, right? You have equal highs here, maybe you have a trend line here of some sort, right? Just based on the way I drew it, you have equal lows here, maybe you have some kind of W pattern, M pattern, whatever it may be. In this case, it's like a W pattern and it's an M pattern and it's a it's a triangular pattern, and it's 5,000 other types of patterns, right? Whoops, excuse that. So what's actually occurring when this accumulation undergoes is this accumulation does not undergo for you to be met with completely new and higher prices, be up to infinity and beyond. What instead is happening is this accumulation is being met to most likely become a redistribution in the case of tapping into unmitigated orders up here, back when price was here, and continuing. For instance, now this whole accumulation is going to look like highs being cleared, Wyckoff occurring, maybe a test comes to mitigate the rest of the supply orders in here and continue even lower, thereby potentially forming a trend line that retail hopes that they traded because they didn't end up taking this because they began seeing their trend channel form here, right? So again, do not think of this in a retail way. Think of this as a way of institutionally price being delivered to you, because what's happening here is price has not shifted bullish yet. It has done so on a very, very lower time frame. And granted, if you had an area here from a while back that you had used as a point of interest or a demand zone, and price had tapped in, giving you this shift in price and continued higher, it's only going higher in this specific case to fill in previous inefficiency and mitigate previous buy to sell moves, which had areas that were left unmitigated. So thereby, as those orders get mitigated, they want to continue on their movement lower. Now, why do I go over this with you? Well, because a lot of the time, the problem that people see is when they look for an accumulation of this sort, they expect, again, for price to mark up. Now, instead of expecting that, allow yourself to expect certain areas to which that price can mark up to. Just because Wyckoff occurs does not mean that Wyckoff is going to take you to the promised land. What it does mean is that it most likely will begin to accumulate and mark up in a direction that will meet next new areas of inefficiency. However, based on what your overall order flow may be, right, from a standpoint of multi-level structure, because again, structure does not operate on just one time frame. There isn't just, this structure right here. Structure is a multi-level, multi-time frame operandum that operates on all time frames at all times, because you're not actually trading time frames, you're actually trading price. Now, that might seem a little crazy based on what I'm saying right now. We're going to go over that in the mentorship, but just consider that idea for a second, that you're not trading time frames whenever you're trading smart money, you're actually trading price, and time frames are nothing more than a way to view the movement of price and to view and find the unmitigated orders, or the orders that are being taken out of the market and being manipulated and being entered on behalf of the composite operator or institutions to take it in a given direction. So now that you understand this, where basically a Wyckoff accumulation does not mean you can go completely higher, but it could just mean that you're coming to meet areas of inefficiency, let's take a look at the actual gold trade that we had. So from a very quick analysis standpoint, I was actually on my phone when I took this trade, so I was kind of just away from my computer. I'll put this up here. In the mentorship, I sent out some stuff after it had gone in. So this was the first trade off the 15-minute. The sell had already gone through, but we just said it's going to most likely come up for another test on the 5-minute Wyckoff, right? So this was a 15-minute Wyckoff. And then I said that on a 5-minute, there's going to be most likely another Wyckoff. Here's the 5-minute chart. Actually, wait, no, there's a 5-minute chart in here. We'll look at that in a second. And lo and behold, we did have that 5-minute chart come back in, right? Continue lower, and we were expecting significantly lower prices. However, it came right back up, and that's after partialing. So let's actually talk about this trade, which to a lot of unfamiliar eyes, or eyes that are not used to seeing smart money operate like this, or even trading operate like this, let's talk about how this was actually a fantastic trade and actually a very profitable and winning trade if you had executed it under the assumptions that we just drew out. Now, what do I mean by that? Let's take a look at what's actually undergoing here, right? So for a while, as a lot of you know, gold has been falling rapidly. Now, we can, of course, expect certain pullbacks in this market. That's very normal. You can expect pullbacks almost anywhere if you want to. But the idea is that we have left areas of inefficiency that reside a little bit higher, areas of inefficiency that reside higher, and we wanted to see some kind of move back up in some of those areas before we either continue on our larger time frame bias or begin to put in a completely new bias, because again, we trade the footprints of smart money. So what we had is on a weekly or monthly, I believe we've been watching this area back since this first impulse was made. After this impulse right here, we've been expecting price to come down into the areas here. So gladly they are here, and more likely than not, we're going to see, and again, this is not financial advice, don't sue me, none of that dumb shit. This is all just perspective based. It's all perspective based just for the sake of educational purposes, okay? So we come and tap into this area, and we're most likely expecting, more likely than not, a actual retracement that may lead to some entries that are going to be able to be presented to you either here or here. Maybe it'll just break down right now as it is, but again, it doesn't really matter because it's all part of confirmation. Now, with that in mind, with the idea that that is what price most likely wants to do, we had this mitigation of that specific area, and from there we had this relatively strong trade up. Now what we left behind was really just this demand zone right here, which was tapped rather recently, leaving behind some liquidity. Now again, these are equal lows, and there are people that are going to be trading this on behalf of retail, and in some case equal lows will work. Now the reason these equal lows are working is not because they're equal lows, but because they needed to mitigate orders that resided in this area that they also had to use to sell to buy for the mitigations of the orders that reside in this area, to also fill the imbalances and inefficiencies that still occurred in this area back from 2020 in June, right? So they came down to mitigate those orders by filling it back in at equilibrium, by coming to mitigate all the orders from this sell to buy movement that basically reside in all this movement. That's why this move right here has been so slow, as it's come to fill in all the inefficiency left behind with this very, very major up move. Came to mitigate some of that. They sold in to liquidate the last few people that tried to buy in here, right, off of some potential equal lows, continued higher, breaking potential structure on lower time frames, came back down to mitigate those sells again, and now is coming back up to an area where you can expect what? Potential sells to either A, liquidate these lows that continue significantly lower, or B, come back into this area to actually give us a proper push before liquidations occur. Now, if this happened, lo and behold, retail believes that their equal lows are amazing, and they'll trade the next equal lows without a doubt and hope that it holds and all that fun stuff. And, you know, over time, it'll continue to fail. But for us, we understand that what we're looking at isn't just based on pattern, it's more so based on the orders in the market. So again, on the daily, we have this mitigation of that area. I was looking at this on my phone, so I did it really quick, but we saw this mitigation, we saw this move away from it. Now we can see that this move away was coming to fill inefficiency and coming mostly for this supply zone up here. It's actually within that supply zone right now, but that's not really important. As we get lower, we notice that this move right here is rather impulsive. And the impulsivity of this move led me to believe that even though we might be bullish for a while and actually expect prices to continue to break higher, right, we might see a pullback that either comes into some inefficiencies here, into the demand zones here, or significantly deeper, which means what? That there has to be some kind of sell opportunity to take into those areas. Because if price is to continue higher, if it wants to, we understand that the composite man needs to sell to buy, right? So in this case, there's a potential that we create liquidity, intermediary liquidity on lower time frames for the day traders, of course, against other retail, against other commercial banks, etc. We have the liquidation of those people that might come and tap into previous unmitigated orders and inefficiency based areas, or even all the way back down here. But I do think that if it did make a way, if price did make a move all the way back down here, the odds of it actually going higher are substantially less, and at that point you'd actually most likely want to look for sells to continue significantly lower. And again, we'll talk about this more in the mentorship on the weekend. For anyone that wants to be part of that, the only site that's available on is this one. I will not ask you for money anywhere else, so please do not be scammed. Let's continue. Also, ignore that. Follow me on Instagram because I post stuff here all the time. So if you want to see some stuff, have at it. Anyway, looking back at gold, right, we understand that we want to see that move back down. That was my bias for this morning. Now that means that I'm going to look for sells. Even though this might be a primarily bullish market, if the sells are to be permitted, there will be an excuse to do it, right? Just like we spoke about a second ago, if you have an area and price comes into that area and gives you Wyckoff, you have an excuse to see that prices had liquidated previous buyers, taken out those buyers, and as a result, incentivize them into potentially new sells, grabbing their orders to now come higher. Now, this accumulation does not have to go and mark up to completely new highs, not to the galaxy, but can make a real markup, meeting some new areas of importance, right? Whether it's imbalances, inefficiencies, or even supply and demand zones to mitigate previous orders before continuing on its either trajectory lower to continue breaking structure, or to continue on the trajectory to break even higher, right? Or just break higher as it is, which is why we always place ourselves and position ourselves in trades that allow us to play with the flexibility of the footprints of the smart money and be involved with them at multiple areas. Okay, so this might be a little bit next level for a lot of you. Please watch a lot of my other stuff and study it to actually understand this concept in a much better way, because it might sound like I'm talking about a bunch of bullshit saying, you can go back and forth, but the reality of smart money is you are actually trading footprints that occur back and forth, because the market does not move in just structural up and down moves. It moves from liquidity to supply and demand zones, to fill inefficiencies, to supply and demand zones, to create liquidity, to take it out, to grab imbalance, to grab newly unmitigated zones by liquidating other people that are buying at these zones, by undergoing potential Wyckoff, by shifting an actual short-term structure to meet those lows, to then take it to potential areas that might incentivize more people to sell, to finally come in and make a markup that takes out the rest of these people, and as they come to buy at these areas, to liquidate them by tapping into new supply zones and continuing lower. This market can move in a variety of ways because smart money is consistently buying and selling in this market. Now, more times than others, you are going to be able to tell where they're doing these buys and sells, and you are going to be able to confirm if those buys and sells are true based on the way liquidity is being created and the way you're undergoing Wyckoff in specific areas of interest. Okay, so with that in mind, we had I believe on a 1 hour chart, if we go and take a look at that very quickly. So let's just replay a little bit of this so you guys can see what's actually going on here. On a 1 hour chart, what you'll see is we had this last up move before the down move that begun to do what? Break real structure, thereby showing us that more likely than not, there are orders that are residing in this last supply zone that still need to be mitigated. Now, if you look a little bit below it, you'll see there has been liquidity created too, which means that at the time of even this wick, think about what this wick did. On a lower time frame, this wick right here actually acted as a huge area of resistance where tons of retail traders began to sell heavily. They're like, fuck yeah, we're about to hit our jackpot. And you go to the 15-minute, for instance, right? And you take a look at this actual rejection. That's your little pin bar, doji, star sign, engulfing candle, weakness in the bulls. You gotta sell into that and they get liquidated, right? Because this is made to begin to emotionally get people involved in this market the wrong way. And this will usually happen before areas of interest where you believe orders reside, and thereby it confirms certain beliefs about where price may go, right? Because if we are forming this liquidity, then the odds of us grabbing that liquidity to then continue at least to some lower areas in price are going to grow much higher. Now you partner that idea with the idea that if we undergo something of this nature in that area, the odds of going even lower are higher. Partner that with the idea that there's inefficiency and areas to be met lower, your idea grows even bigger. The beautiful thing about smart money is that you can refine your edge to its last possible point. And if you want to learn to do that, check out the mentorship. Now, as you understand this, let's take a look at the 1 hour really quickly. It's about an 18-minute video right now, so I'm going to kind of cut it off pretty soon. Here's the inefficiency you have right under it. Here's the last buy to sell that has orders in it that need to be most likely mitigated. Let's see if those orders need to be mitigated and if price wants to be taken lower. So at this time I was on the 15-minute, and as you can see, we are beginning to put in potential liquidity. Now, for those in the mentorship, you already understand how we're looking at this as a potential preliminary supply, looking at this as the BC, AR, potential ST or ST here, making liquidity, and we're looking for the liquidations, right? You guys understand that because we've gone through Wyckoff in depth. Now, let's take a look at what actually occurred. Price comes up and taps the area just like we expected. Now, when it taps that area, notice what it does. Not only does it tap that area, but it also creates liquidity before it taps it, making what happen? Multiple people looking to sell these equal highs, the triple highs, the W, the M, whatever pattern you can see here, because guess what? There's 5,000 different patterns you can see here. Maybe your little triangulation big rotation. It doesn't matter, right? There's a bunch of the star sign, doesn't matter. They're all looking for stuff to sell or buy in there. There's people getting involved on both sides of the market. Hence the fact that there's wicks being created on both sides, wicks being created on both sides. People are selling and buying this market respectively because emotionally, there's always going to be something someone sees to get involved, which is why, again, the market is dynamic and flexible and can change. Now, the 15-minute setup happens. Let's speed this up a little bit. Falls off. After these breaks, we're looking for the sells at where? The last buy to sells with the inefficiencies left behind, understanding that are more likely than not areas in here that are going to want to be, where there's going to most likely be sellers. Now, as we come down, notice what happens. We leave behind an inefficiency, okay? So that means that now we've undergone Wyckoff. Now, for anyone that wants to go label it, go do it on your own. But honestly, the easiest way to look at this one specifically would be the buying climax, the AR, the ST creating equal highs, or a start of a trend or some kind of thing like this. The upthrust, the UTAD, the breakdowns, the test, the breakdowns, and you're looking for the LPSY. Okay, now what's interesting is the thing we spoke about before, which is where you have an area, you have accumulation come into it. Now this can either go to the moon or it can stop at an area of inefficiency. Now ask yourself, if this were to tap into this, where can it go? A, it could go into this area of inefficiency and become an accumulation, or B, it could continue significantly lower to meet what? Well, remember what I spoke about, to meet the inefficiencies way down here. So if it wanted to do that, this potential trade already resides for you at a, if I can actually get to it, that'd be fantastic. This trade already potentially resides for you at a 1 to 24, right? At all the way down here. Or if it does continue to those lower points, which we're looking at, a 1 to 40. Now, that doesn't mean it's going to happen, but it means it can happen. And understanding that is what allows you to partial. So on the 15-minute, you get this distribution. We get it to tap in right here at that area. And as we continue lower, where do our partials begin? The partials begin below these lows. Why? Because we are trading with the banks. We are looking to take profit at areas where they may take profit and reverse price. One of those areas is here. Another one of those areas is here. Whoops, is here. Another one of those areas is inside here, and so on and so forth. And you can follow this all the way down, okay? Now, I'm not going to continue doing this for a long time. So 5-minute, what do you see happen here? The same thing occurs. Before it taps into this area, we have liquidity being created, liquidations, UT, UTAD, breakdowns, expecting the test. From where? The last buy to sell. Play this out. Notice what happens. Comes back up, buy to sell. If it is to continue higher, where could it do it from? The liquidation of the lows created, boom, into the demand zones, and continuations higher. Now that's exactly what happened in this case, but there was no guarantee that this was what it wanted to do. And very easily, this move could have actually continued all the way back down here, in which case I would have locked in a 1 to 600, 1 to 500, made a video on it, and been called a scammer. Either way, doesn't matter. The point of this is that you understand that a distribution or accumulation can still have a markup or a markdown that isn't infinite and could come into new areas of inefficiency. So thank you so much for watching, guys. I hope you enjoyed it, and I will see you in the next one.